The markets have been busy lately, from economic shifts to government uncertainty, and many investors are wondering what it all means for their money.
And this morning, we're joined by a financial consultant and chartered financial analyst, John Rhodes. He manages the Charles Schwab branch here in Augusta, and he's back with us here in the Mix Studios to walk us through the latest market news, the recent government shutdown that made a difference. How these seasonal patterns can also affect investing. Good to see you, John.
Yeah,
Great to see you, Cliff, Mary.
Let's start with the basics here. What's the latest from the financial markets right now?
Sure. Well, the latest is both the S&P 500 and NASDAQ hit all-time highs in late October. The Dow Jones Industrial Average then did the same in early November. Since that time, we've sold off a little bit, less than 0.5%. So it's a very, very small little decline. It's a pause, as we talked about before.
Right.
Markets need to take a pause periodically, and we've just kind of been through that recently. Although last week was a very strong week, but this week has gotten off to a start with a little bit of a pause. I think we've talked about before the 10-year Treasury. It's a little we're watching as the interest rate that it's begun to climb above 4%. We're at about 4 1/8 right now.
Okay.
That could climb a bit, ironically, as the Fed reduces short-term rates.
Okay.
It's kind of odd. Yeah, it's kind of a seesaw.
It is, very much so, yeah.
Yep.
Well, we just came out of a government shutdown. Did that have any real impact on the economy or the markets?
It did. Some of the jobs data was a little weaker than had been anticipated. We had been expecting a lot more job production in October, and well, the November numbers aren't out yet. But we actually had a decline in new jobs, and so that was a little unsettling to the markets, but it was not catastrophic by any stretch of the imagination, and it could be simply due to bad data because we didn't have all the folks compiling the data as they typically do.
We mentioned seasonal patterns just a second ago, and that's in investing as well. Now, is that something that everyday investors should pay attention to? Is
Absolutely.
that something that is kind of a...
Well, it's ironic. We just had the Grinch in here,
yeah.
and the financial markets very frequently have what we call the Santa Claus rally, which is investors want to get positioned for the new year, and they typically start getting positioned, mid-December. So we're probably anticipating on the aftermath of the Fed cut, hopefully tomorrow, that we'd see a little bit of positive action in the financial markets through the end of the year.
So looking at the economy overall, what indicators are you watching most closely as we move into the new year? I
think the 10-year Treasury is probably the #1 barometer to watch.
Oh, yeah?
As long as we stay, under 4.5%, that's benign. It's not going to impede growth or cause any problems with valuations, that kind of thing. Remember what we've talked about before is the reason that rate is so important is that's how we calculate the present value of future earnings. And so future earnings are not worth as much if the interest rate is climbing. We really don't anticipate it getting higher than, say, 4.5%, and that's significantly above where it is now.
Right. Okay. So and again, as we've always said, don't jump.
Right.
Don't flinch.
Right.
You got to watch the market and just ride it out.
I think we've kind of compared it to the tides before.
Right.
The tides come in and out every day. The markets do the same. They advance and they recess, advance and recess. And as long as you're not falling below substantially below where you were previously, you're making a positive return.
All right.
Okay.
Great stuff to keep in mind. And John, always great to see you.
Yeah, thank
Appreciate
you.
you coming.
Thank
Have
you.
a happy holiday.
As you as well. Thank you so much.